morning to the eastern side of the United States and good evening to South Korea. My name is Ethel Margolin, Head of Corporate Development, and together with me I have Tonia Cephas, the M&A Analyst, Johnny Tarkback, Investment Specialist, and Si-Jun Yu, Chief Investment Officer at Johns Hopkins Carey Investment Team. This M&A would benefit Oracle since Sun Microsystems was mainly making hardware and storage while providing service at an enterprise level. Oracle itself is one of the largest sellers of database management and other software systems. Like mentioned in the study, an easy way of comprehending the acquisition would be to imagine Walmart of the enterprise software industry. Oracle can grow bigger and better while using the core strength in hardware and networking to create a good customer platform, which Sun Microsystems has agreed to help Oracle expand its reach within customers and cross-selling. Sun Microsystems is being undervalued within the market range, and the M&A of these two companies can create synergies and 3 storage and software platforms, MySQL, Solaris, and Java. Since Oracle and MySQL do not have the same clientele, there would be no competition between the companies, and this would attract high-end clientele to buy the software. Oracle had a goal to become a business such as Apple. With this acquisition, this goal can be fulfilled. Standalone value will help us to calculate the value of Sun Microsystems prior to adding any synergy, and it gives us a clear value of what Sun Microsystems is worth prior to M&A, and that it is not being over or undervalued. Discounted cash flow shows us how much profit the company will make, and to be able to adjust it based on the value of money, we need an accurate cash flow to be able to use the DCF. And the WACC for a beneficial acquisition, Sun Microsystems will need to generate greater returns than the WACC. I'll hand it over to my colleague, Johnny. Thank you.
We continue this analysis using the discounted cash flow. The goal for us using the DCF model was to determine the share price from a cash flow perspective. First, we determined the free cash flow available to the firm using the main WACC for some of the industry players as a proxy. We use this WACC to discount the free cash flow. In doing that, we determined the following. 1, the terminal value of the firm. We took the MPV of the terminal value. We got an enterprise value as well, and then we determined the equity value. We determined the share price to be $6, but that was not the end of what we were doing. We did a sensitivity analysis as well, using the growth rate and the WACC, and determined a range of prices from $6 to $10. The range actually gave us a buffer to make a bid within that range. And this can make a huge difference going forward. Since we had a competitor who had offered a price of $9.40, we used that buffer based on the sensitivity analysis to make a counter offer in case our competitor decided to up their bid. An initial price offer of $9.50 makes more economic sense given the synergy we could derive from the acquisition. And I'll turn over to my next colleague.
This slide captures multiple analysis for comparable companies to Sun Microsystems. The columns have revenues, EBITDA, market cap, book-to-value debt, cash investments, EBIT, enterprise value, EV to revenues, EV to EBITDA, and EV to EBIT. For the selected multiple, we simply selected the average because the size of these companies had a wide range, and we wanted to find the value that can reasonably capture the average value of all the companies. From this point on, we decided to weigh revenue 60%, EBITDA 20%, EBIT 20% to calculate the equity value per share. And after calculation, equity value per share came out to be $6.24. These are the 3 multiples that we use for the calculation. Enterprise value to sale multiples. This is one of the key indicators the investors use to determine whether a stock is priced fairly. Higher means the stock is overvalued and not profitable. Lower means it is undervalued, therefore profitable. EV to EBITDA looks at the purchase price of the business relative to the last 12 months' EBITDA generated by business. Simply put, a high EV to EBITDA means the company is potentially overvalued, while a low EV to EBITDA means the opposite. EV to EBIT, the enterprise value to earning before interest and taxes, is used to determine if a stock is priced too high or too low in relation to similar stocks in the market as a whole. This slide identifies the synergies of Oracle acquiring Sun Microsystems. With given data, the net present value came out to be $8,013.61 million, with internal rate of return of synergy investment to be 166%, which is a profit. We used various discount rate to do sensitivity analysis for the net present value. The maximum discount rate we used was 12.28%, which gave the lowest net present value of $7,157.81 million. The lowest discount rate we used was 5.28%, which gave the highest net present value of $9,354.35 million. We also did another set of sensitivity analysis using different growth rate. However, the calculation came out so that the internal rate of return of interest plateaued around 166% at the highest point. With growth rate of 3.12%, the internal rate of return came out to be 122%. I'll be followed by Ms. Tonya Cephas.
Thank you. So as my colleagues have mentioned, we have done our due diligence by conducting several valuation analysis to determine what is the best possible price for us to contribute to this merger. After looking at comparable companies, we were able to gain a median WACC of 9.28%. And so it was only right for us to do a single analysis WACC valuation for Sun Microsystems. And in our calculations, we came up with a WACC of 12.84%, which was higher than its competitors. And so looking at that WACC, and we are expected to see an internal rate of return of 166%. And so this merger makes sense because we've had history with Sun Microsystems. Since 1997, we have been using Sun's Java programming language and its Linux operating system. We also have commercial clients that are using Sun servers with our databases. And so it is only right that we continue to push for this merger with Sun Microsystems. And with our only real competitor being IBM, who is now having some issues with their employee contracts, antitrust concerns, and other financial woes, we are very positive and confident that this price is indeed the best price and the highest price for us to come in with this deal. And that is at $9.50. And so if you have any questions or concerns concerning this deal, please reach out to us. And thank you for your time.